Hello everyone, and welcome to the Quantpedia Explains Trading Strategies video series. Today, we will discuss military expenditures and the performance of the stock markets.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will once again discuss macroeconomic theme. We will speak about military expenditures. I think that's quite an actual topic if we consider what is happening all around the world. But I would say it's always an actual topic because there are always some geopolitical crises all around the world. The world is a big place. We will discuss what's the impact of military expenditures on the performance of the stock markets all around the world. I will show you some examples. I will show you what data set we used to do the analysis, and we will discuss the results. First, a quick introduction. There is very nice old Roman proverb, si vis pacem para bellum, which we can translate into English as if you want peace, prepare for the war. I mean, it's the main idea behind the military policy of a lot of modern national states. Hot war is not very often waged among the countries, luckily, so it's not popular as it used to be because it has negative trade and business repercussions, as the Russian Federation realized in 2022. But nobody wants to be cuffed militarily prepared in case of global or local geopolitical crisis. The national states in the current situation are always trying to be prepared for, anything, any crisis that can happen. So countries invest a lot into the military. Now the question is if those military expenditures are financially rewarded. Do stock markets of countries with the strong militaries outperform their peers? And that's the question we have decided to answer in the following analysis. So firstly, there are some other articles that are related closely to what I will discuss today. The first one is the nuclear threats and factor performance. So that the article we wrote around a year and a half ago when there was the beginning of the Russia and the Ukraine conflict, and it's about what's the impact of the nuclear crisis on the stock market. So if you are interested into some geopolitical articles, I also recommend this one. And there is also another one, the worst one-day shocks and the biggest geopolitical events of the past century. Once again, that's the article which shows what's the impact of some geopolitical crisis on the stock market in the US. So let's continue with our article. So firstly, some relative literature. Of course, we are not the first to ask how the geopolitics affect the markets. So there are some research papers that are trying to understand what is the effect of military expenditures on the stock markets. Now, the result is really mixed. There are some papers that show that high military expenditures has a negative effect on the performance of the stock markets. And there are other papers and they show that the high military expenditures have positive effect on the performance of the stock markets, especially for the United States and United Kingdom. And there are other papers and they show that there is a mixed result. So, it's really hard to pick what can be the true out of those papers. So we try to do our own analysis. What's our methodology? Our dataset for returns on stock markets in countries is the same as the one that we used in previous analysis regarding the reversals. We have a dataset that starts in 1992, so it's more than 40 years old. We are using the ETFs, and in case we do not have ETF data, we are using MSCI indexes. We have around 22 countries in our data sample. It's a mixture of emerging market countries and developed market. Of course, we have the biggest stock market in the world, so a US market, which is proxied by SPI ETF, and before SPI ETF is the MSCI index. As a source of military expenditures and spending, we use the Stockholm International Peace Research Institute database. So it's this one, CIPRI Military Expenditure Database. That's the database that has data from 1949. It's updated yearly. Right now it's year 2023. And the database has data until 2022. So there is always a lag when the database is updated. Of course, we work with this lag. So how is the dataset constructed? So our backtest starts in December 31st, 1992. And that's when our backtest starts. But in 1992, we know what's the military spending for year 1991. So what does it mean? So at the end of year 1992, we use the data from year 1991 as a predictor, and we hold a portfolio for year 1993, so it means from end of 1992 until the end of 1993, based on the predictor, which is in our case the military spending. And after the year we do the rebalance, so it means at the end of the year 1993 our decision based on the data about the military spending of the year 1992. So there is always one year lag. How does the strategy look like? As I said, we have 22 countries and we were undergoing the battery of tests. We are going the long X countries with the highest military expenditures, and at the same time we short X countries with the lowest military expenditure as reported for the year T-1. And we are undergoing a battery of tests. We change X 1 versus 1, 2 versus 2, 3 versus 3. So it means we are long 5 countries, short 5 countries, long 7 countries, short 7 countries, long 10 countries, short 10 countries. And we are testing the strategies with and without the US ETF, so without SPI. The reason for that is because United States is the biggest spender on the military in the world in dollar amounts, and most of the time also in the percentage of GDP. SPI ETF is always picked in the long line of our portfolio, and we wanted to test the impact of military spending on the stock market when we remove the stock market of the country with the strongest army, so when we remove the US. That's the reason. So we are testing the sample with the US and also without the US, and then we are driving the conclusions. Plus we tested 2 predictors. The first one is the total dollar spending, and then there is a percentage of GDP. So, and let's take a look at what are the results. So firstly, we analyzed the total US dollar spending data. Of course, we found out that US is always the first. So, I mean, the US is spending the most money from all of the countries on the military. We are always long SPI, and if there are more countries that we are long, so like 3 versus 3 or 5 versus 5, usually it's other rich countries, because the rich countries, they have more money to spend on the military against one or more poor countries that spend the least in total dollars on the military. I mean, usually the emerging market countries and small countries are those that spend the least. So, I mean, this metric, when you go just long based on the dollar spent and the short based on dollar spent, is basically like going long US plus few of big countries against the poor emerging market and the small developed countries. So that's how does it look like. The performance spread is positive. So the question is why? The US spends more on the military than the next 10 countries in the ranking together. So I mean, this is the spending for year 2022. As you can see, the US spent over 800 billions on the military, and 10 other countries altogether spend less than US. Also, the interesting question, what's the impact if we try the same metrics, so total dollar spending on military, but without the US? So how does the results look like? And here are the results. So we can see that if we remove the US, there is absolutely no outperformance, so the spread portfolio doesn't outperform. If the spread portfolio performs, it's solely due to the impact of the US market, because US market is outperforming. It's one of the best performers over the last 30 years, and US is also having the high military spending. So if you remove the US from the equation, then the military spending in total dollars stops being predicted at all. Is the US case somehow the special? I mean, it's hard to say from the data we have. The military spending has absolutely no predictive ability for the rest of the world. But it may be possible that the high US military spending imposes some kind of Pax Americana. So it means US spends a lot of the money on military and is policing countries all around the world. And this piece translates into favorable business opportunities, but only for US companies. So our quick analysis hints that there is some truth to the paper that we mentioned before at the beginning. So yeah, the high military spending has a positive predictive ability, but only for the US. Now let's take a look on the second part of the analysis. In the next, we targeted military spending as a percentage of GDP. The percentage of GDP is a better measure. The reason for that is because then it shows, I mean, how much the country spends compared to the relative size of the country. So the US is replaced in the first place by Taiwan for 2 years and by the Singapore for 10 years from years 1993 to 2005. The US is not always the first. That's a better measure of the spending. So what are the results? The results are almost the same as in the case of total dollar spent. So if you include the US, we have a positive spread. So 1 versus 1, 2 versus 2, 3 versus 3, 5 versus 5. I mean, when we diversify too much, spread goes down, but there is still some spread. Of course, it's smaller than in the dollar spending, but there is still some positive outperformance. So the countries that spend the most as a percentage of GDP on the military, they outperform the countries that spend the least as a percentage of the GDP. But this is still with the US included. Now, what would happen if you remove the US from the investment universe? And here we have it. So once again, there is small, very small positive spread, but it's really, really small. So we can see that long-short strategies without US based on the military spending as of percent of GDP are faring slightly better than those based on total dollar spending, but the economic and statistical spread is close to insignificant. Yeah, there is some spread, but very, very small one. What is the conclusion and what are our final thoughts? So what our analysis hints is that US is probably really a special case among the countries. It has the strong economy, and this strong economy allows US to invest a lot into the military, which helps to maintain a strong economy, which helps to invest once again a lot into the military sector, and so on and so on and so on. So it means for the US, the military expenditures paid well. It's the biggest country, the strongest country, I mean the biggest from the perspective of the GDP and economy, the strongest country from the military perspective, and the big expenditures to military are probably helping the US to maintain this current status. For the US, the military expenditures paid well. But it's not the case for the other countries. We were not able to find a significant relationship between military expenditures in total dollar terms or in a percent of GDP and the stock market performance. There is one underlying factor that can impact the performance of the US stock market versus the rest of the world, and that's the factor, the strength and weakness of the US dollar. Because we already analyzed how is the performance of stocks, commodities and bonds influenced by the strength of the US dollar, and we can suspect that the US dollar factor has also impact on the performance of emerging and developed stock markets. It doesn't have to be only by the military expenditures, but it can be the reason how the results are looking can be because our analysis is based on ETFs that are priced in US dollars and not in respective local currencies. So the analysis of the impact of military expenditures can potentially look a little differently if we analyze local currency returns in international stock markets. But for the US dollar investor, our analysis holds. So it means the big military expenditures for the US translates into good performance of the US stock market, and it helps US from the trade and business perspective. So at the end we can just end with a quote once again. So Theodore Roosevelt is known for saying, "Speak softly and carry a big stick, you will go far." Sometimes it's called the big stick diplomacy, and we can say that this saying has some merit in it. So it definitely pays well for the US. It doesn't pay well for the other countries, but it definitely helps the US. I hope that you like this macroeconomic analysis. I mean, it has definitely some repercussions and practical use also for trading or investment. Of course, not for day-to-day trading, but when you build your portfolios and when you tilt your portfolios, I would say that you will not make a big mistake to tilt the portfolio to the US. So I hope that you liked the article. I hope that you subscribe to our channel, and I hope that you will join me in the next video. Thank you very much.
Interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.